Well, look, we've been constructive gold for quite some time. I think the vaccines changed our view slightly in the sense that we have probably the most bullish forecast out there to 3,000 over 18 months. The development of vaccines probably slowed that down. It's not going to happen now in short order, but we still expect gold prices to rise. We are still projecting an average between $2,000 and $2,100 an ounce throughout this year. So we see a little upside, but not dramatic.
Well, that's not the kind of upside that's going to get anybody excited. Why are you more bullish? I mean, it's interesting how a lot of people in the last several months actually have been very bullish on gold. Maybe the price performance didn't quite measure up to that. But why do you think it basically is just going to move sideways?
Well, because I think over the next few months, as more people get vaccinated, which is what you had on your prior segment, we are going to see the economy coming back. And we think it's going to be cyclical commodities, namely copper, but also potentially oil, pushing prices higher across the commodity complex. And gold is going to lag a little bit on that front. And also importantly, remember, we are heading towards the end of the last few packages, fiscal packages. And also, I think it's going to be hard for the Fed to keep easing monetary policy at this point. And those two tend to be important headwinds for gold. So we are constructive. We're just not very constructive here. We think gold probably moves higher only on the back of a weakening U.S. dollar over the next few months.
A weakening dollar, which is underpinning so much of the moves that we've seen. Again, point out silver's doing nicely, even though you'd think it'd be selling off with the rest of the market today. So what about oil? Where are you on crude, which has more supply side issues to contend with than most commodities?
Right. So oil, as you pointed out, there's a lot of spare capacity. Today, OPEC met to try to figure out what they're going to do for production in February. As we know, in the past month or so, OPEC has changed its longstanding policy of shock and awe to the markets to doing something which is a bit more Fed-like, making monthly adjustments. The problem, of course, is that you have a lot of different players shooting in different directions. It's a complicated marriage, and some are in floating mortgage, if you like, some are in a fixed rate mortgage, and that creates strains across the organization. So my sense is that for the next month or two, with the new UK virus strain hitting some countries hard and leading to more lockdowns, we could see a relapse in prices. But then heading into the middle of the year, we still expect Brent to hit $60 a barrel, probably by the end of the second quarter, as we get back into a more normal driving season. We expect vaccines to be really fully rolled out. Sorry.
No, go ahead and finish the thought, Francisco.
No, I was just saying, I think as soon as we get those vaccines rolled out to the broader population in the U.S. and Europe, you're going to see a big pickup in mobility. A lot of us have been really holding back travel, holding back family travel, business travel because of COVID. And I think as soon as that starts to ease, we're going to see a big pickup in demand for oil, and prices will move higher. But to your point, there's a lot of spare capacity. So the organization, OPEC Plus, is very keen to bring those barrels back. And that's, I think, where the strain is right now for the market. So expect prices around $50 a barrel, 48 to 52 on Brent, 53. And then as we go into the middle of the year, probably a 6 handle is likely, in my view.
Shepard Smith here. Thanks for watching CNBC on YouTube.